You are listening to The Investor Way with Sam Ball and Jonathan McEwen. If you enjoy the show, please subscribe and follow us on Twitter at TIW Tweets.
Hello, welcome to The Investor Way with me, Sam Ball. It's the 31st of January 2026, and I'm joined today by my special guest, Arthur House.
Hi Sam, how are you?
I'm very well. How are you doing?
All good, thank you. Ready to go?
So, Arthur is a 22-year-old real estate professional with an early and genuine interest in investing. He spent part of his schooling in the Bronx, New York, before returning to the UK and graduating from the University of Reading with a 2-1 in real estate. Arthur now works at Knight Frank in their residential investment team, where he focuses on residential investment analysis and advisory work. He began learning about investing at a young age and has continued to build his knowledge alongside his professional experience, bringing a thoughtful and grounded perspective to investing. So, firstly, thank you very much for coming on the show. And secondly, would you be able to just I know I've had that brief intro, but would you be able to just talk us through in your own words, your investment journey today and how you became interested in investing in the first place?
Yeah, absolutely. Well, thanks again for having me on, Sam. I did give this a little bit of thought just in terms of where it all started, because you go through the early stages of learning and it's quite difficult to pin your hat on exactly what the first thing was that actually raised that curiosity for you. So I can basically pin it on back in the school days when I was 14 and I joined the school investing club where we all had about £100,000 of virtual money and we would put it into a virtual portfolio and we'd basically battle it out throughout the year. And there was something like 50 students. And what I would do is I would buy these illiquid micro cap pharmaceutical stocks. And because there was no trading fee in this virtual trading account, I would just arbitrage the bid-ask spread because these are liquid pharmaceutical companies would just tick up and down between their bid-ask spread, when there wasn't much activity in a typical trading day. And after sort of 4 to 5 months, these constant trades in and out that I would be making every day in between lessons and during free periods, I would just steadily incline. And eventually I won that race to get to the highest value by the end of the year. And there was a bit of an issue because the person that had set it up had access to all of our accounts. So there was a bit of drama, which was quite funny, but there was also an irony in that he sent an email to everyone and basically said to us that I was cheating because there were no trading fees. Well, that kick-started my interest. And ever since, I opened up my first account in sort of 2017 and have been sporadically investing since when I've had the spare capacity. In the 9 years I've been investing, I've owned American stocks, UK stocks, and frankly, a short list of forgettable investments elsewhere in the world, such as Australian gold mines and South African REITs, you name it. Yeah, it all started for me about 9 years ago with that investing club and all the drama surrounding it.
So you're 22 now. So then how did you actually start investing 9 years ago properly? Because you couldn't have set up an account.
No, and it was a difficult one because we were British citizens living in America. So I was trading through my dad's name, but then the additional difficulty was that everything I was buying, so all of these US stocks I was buying, even though we were in America, I was having to buy them in pounds. It was a costly, frustrating process, but just having that real account, and it was very small amounts of money, but yeah, it was under my dad's name.
Do you think being in America actually made a difference then in terms of getting started?
Yes, and I think it made a difference for me personally because the demographic of people that we lived around had far more interest in the corporate world than where I'd grown up because my father was in the military. So for much of my life, we lived in and around barracks where the private sector is not something that you really spend any time thinking about. And when we were out there, my dad was getting to the back end of his military career and so was needing to start thinking about how he'd expand and what he'd do with his career post army. And I think I just happened to be quite impressionable at that point. And with the people that we were surrounded by, our neighbors and our friends and my friends at school, it just came. It was a world that I hadn't really thought about before. And as soon as I joined this investing club, and with these virtual funds, I suddenly realized, it was mostly pot luck, but I thought, I might be quite good at this, so let's give it a go. And then ever since, I've just tried to learn as much as possible.
Could you just talk a bit more about that transition then? So you've done the investing club, you've then gone on to trading under your dad's name in one of his accounts. What then happens, say, from the point of 18? Presumably you're then setting up your own accounts.
There wasn't really like a find point in which all of these different things happened. As soon as I was 18, I was trying to set my own account up. There weren't really periods where, even though our life was changing drastically, like whether, when we were moving back from America with me starting a new school or starting university, I think my learning journey has been pretty consistent throughout because I've had such a strong interest in it from the outset. And I think quite confidently I could say now that it's kind of a part of who I am. Like if I'm talking to someone and they ask me about my hobbies, then investing's right up there as one of the first things I'd say. So for me, it's just been pretty easy, despite at what stage of life I've been at. And I guess, or at least get that when you're going through school and there's a lot going on, it's difficult to find the time to do it. But actually, for me, because it was such a natural interest, it just evolved from there.
See, I think the time would be okay for me. It's the money at that age.
No, I
Especially
know,
because I
Sam.
think as well, if you go back a few years,
Yeah,
if you're talking sort of 20, sort of certainly pre-COVID, the investment fees were higher as well. Sort of the zero trading fees, that's really a kind of COVID onwards thing. And
I
when
agree.
you're with such small amounts of capital, it does eat into it.
Well, this is one of the things, Sam. I haven't mentioned the financial amounts that I've been talking about, but when I first started, I bought two companies. One was Lending Club, which is a peer-to-peer lender, which I put £100 in, and the other one was Versatis, which was again a kind of illiquid pharmaceutical company. Why I was buying in these sectors, I don't know. I knew absolutely nothing about them. But I remember I returned something like 45% on both of these companies. So objectively, and just looking at the percentages, that's not a bad return, especially for someone that knew absolutely nothing about the sectors in which they were investing in. But with the trading fees, and I was using Hargreaves Lansdown at the time, I think I was paying £12 per trade. So that's £24 to enter and exit. And then on top of that, there were Forex fees because I was having to convert them from dollars back into pounds. So I think I ended up losing something like 10% per trade, despite basically generating 50% unrealized return.
Yeah, I think Hargreaves was probably the worst possible platform for something like
I,
that.
I I think in retrospect, I'd have to agree.
I mean, in fairness, I'm still on Hargreaves. I've been using that for years, but I got an email. I don't know if you still use Hargreaves. I'm assuming you've moved on since.
No, I still use them.
See, did you get that email the other day where they're
I
putting the
did.
fees up? I think I'll be finally moving on soon, but
Well, one of my problems, Sam, is that I'm a little bit trapped because I put my money into a lifetime ISA. So there are a whole load of issues now that I have in terms of withdrawals, and because I don't know, do you know much about lifetime ISAs?
yeah, so I've got one, so which is because it's a stocks and shares one. Quite a lot of
Yes,
providers don't offer it.
exactly.
Obviously, I'm a bit older than you. I'm 30, but it has served me really, really well in that I've been doing it since like the second year it was introduced,
Yeah,
and it really does build up after a
it
few
does build
years.
up. And I get, as long as you completely understand what the limitations are in terms of your access to that money, then I think it's a really sensible thing to do.
But I think as well, I think at your age though, it's you're almost certainly going to buy a house at some point,
Yeah,
and that's when you're going to get that access to it. And I think because you've got that, that makes a huge difference. So like I'm now going through the process of buying a house right now. So there's a good chunk of it that's coming out.
yeah.
But then after that, I can't touch it for 30 years, which is a bit
Yeah.
depressing.
Well, that's the other thing. The outside of a house, the parameters are slightly depressing. One being a terminal illness, and the other being when you've reached the state retirement age or something.
Yeah, we're 60, so it's a bit lower than state retirement. But I'm hoping I'll be next drawing when I'm 60 rather than terminally ill. But you know,
I hope that for you too.
yeah. So at the minute, I mean, I'm going to have to stick with Hargreaves because I'm like literally part way through the process of buying a house, so that the deposit's coming out of the LISA.
Yeah.
And then after that, I am just going to look at other providers. But I don't know how many actually do stocks and shares ISAs.
I don't think there's many.
No, I've got an ISA with them as well, which is definitely going to move because I've also got an ISA with Traded 212. So the ISA's dead easy. When you're earlier on in that investing journey and you're not earning as much,
Yes.
it can be quite difficult to actually hit that 4 grand. But once you start earning more, that £4,000 for the maximum is quite a low, really, it's quite a low threshold. If you compare it to like the 20k ISA limit, for example. So what I quite like is, although you can't get it till you're 60, well, you're probably going to be maxing it out every year. And then hopefully everything above that would be in an actual ISA, which you can get at any point. So I think as long as the two are combined, I think the ISA is a really, really useful tool.
Yeah.
But if someone said to me, well, for the next 40 years, I'm only going to have £4,000 a year to invest, I probably wouldn't put it all in the ISA, because then if you do want to retire early or anything, you just don't have that option.
Yeah.
I think as well, I don't know if you saw, but the other day, I think they're basically going to can the lifetime ISA. So people who've got them, there'll be like a grandfathering provision where they'll stay in the system. I think they're bringing out some kind of new help to buy ISA thing. So you're just going to have this generation of people where it's like a sort of 10 or 15 year window that have the lifetime ISA, and then that's going to be it. So I'm kind of hoping that it might get forgotten about. So they won't, like, for example, they won't increase the age at which you can withdraw from 60. Because otherwise, I could see that going up.
Well, this is one of those other problems, Sam, which is I do feel like there are, or I've at least read or heard about, so many occasions where they, as in the government, don't make it conducive to investing and saving, because the likes of stagnating the increase of the ISA limit, you look at the rate of inflation and wage increase and whatever, but they keep fixing that the ISA and LISA, but more people use a regular ISA at 20 grand, which hasn't really moved.
I suppose my counter to that would be, I do agree, but I think when the ISA was first increased to 20,000, that was a really, really high limit, especially for a husband and wife, because you've got 40 grand between you, which kind of most sort of quote working people would never actually get anywhere near. So I obviously, yeah, it's not as good as it was 20 years ago, because that 20 grand was a lot more. But for most people, if you can invest 20 grand a year tax free, it's still a really, really useful tool. But I think part of the issue is as well, is like, it wouldn't surprise me if in 10 years' time the limit's still 20 grand.
Yeah.
And at that point, it's like with the inheritance tax, where those thresholds have just stayed flat since like 2009. And you're now at the point where like a normal person's with a house in their estate is probably going to be liable to inheritance tax, which was never the original intention. But that's just the easiest way to collect tax, unfortunately, is just through fiscal drag.
Yeah.
Would you be able to talk about your own investment appraisal process then, and how you would now approach looking at a new stock or investment, and what you'd go through and what you'd look at before you'd actually decide to sort of pull the trigger on it?
Yeah, sure. So my appraisal process is primarily built on watch lists. So I will constantly refine these watch lists as new opportunities emerge and older ideas evolve. I try to segment everything by structure. So I'll have a watch list for ETFs. I'll have a watch list for ETCs, exchange traded commodities, equities, and then I will subcategorize beyond that by profile. So if that's if each investment opportunity is high risk, high volatility, or more of a value driven investment. So before I really start looking from a bottom up approach, I have a prefix of almost every kind of investment that I could see myself wanting to make in any given time, which is quite difficult to track. But at the same time, if you just compound and keep adding to these watch lists over the years, what I do is if I kind of identify something in the economy, say if I believe that growth may pick up in the next 2 years in a certain sector, or if there are kind of legal legislative tailwinds, then I might basically start refining a watch list that I reckon would be well suited to essentially profit off that given scenario. So my appraisal starts with just having my eyes on as many different sectors, industries, asset types as possible. And then as an opportunity comes across, or kind of comes across my desk, then I will decide, well, how or what investments am I already following and know a lot about that I can then just deploy money into, so that I can save myself the time and the effort, especially now that I'm working full time. And I only have been now for 4 months, but it's amazing how much free time you don't realize you have at university until it's all gone. And so having these watch lists that cover so many different asset classes is incredibly important when you are basically time poor.
How many assets then would you say are on your watch list? Because it sounds quite big.
It is, Sam. It's something that I add a lot to, and I'm not very good at reducing, kind of chucking companies out if they just constantly performing poorly or I've lost track of them. And it's very easy to say, I have a whole load of watch lists that I refine all the time. And in fairness to me, I do spend a lot of time looking at these watch lists, but over time, sometimes you just lose track of one or two or many more companies, or you just don't really see an interest or a reason why you could see yourself investing in them. And I find this with commodities quite often. I'll follow, because there aren't that many spot commodities that I would ever invest in, just because my knowledge level when it comes to the alternative assets is far more limited than my knowledge of equities, say. So I'll just refine these watch lists when I can. If I take my probably most looked at watch list, which is my kind of value driven opportunities watch list, that's probably got 60 companies in.
Okay, so that's not too bad then. So besides the equity one, then would you be able to give a couple of examples of other watch lists and what's in them?
Obviously, when I started out, it was a bit of a just learn on the job kind of situation where even though it was virtual money at the beginning, I was just putting money into stuff that I knew nothing about. And in fairness, and as I kind of briefly mentioned, Sam, I put £100 of real money into these different stocks in just the same way, and the trading fees would just eat away at any profit that I made. But they essentially are made when I have an interest or I feel like there's a reason to learn something about a new sector or a new asset class, depending on kind of what level of subcategorization you're getting to. One recently, and I know I'm sure we'll get onto my current holding, which is gold. Gold is something that a year ago I didn't know very much about at all. I thought it was something that your grandma buys when she's 25, and actually there's a lot more to gold and these other sort of precious metals and commodities than what meets the eye. So I have, on that note, kind of a precious metals commodities watch list where it's just helpful because I don't know if you've seen, but in the last 24 hours, today being January 31st, silver has dropped 30%. And I know it's at record highs, but 3-4 months ago, or maybe a little longer, but I wouldn't have known or been following silver, and therefore would have had no idea what's happening in that side of the market. And the thing is, the more asset classes I follow, the more connected everything seems than when you first start researching it. Most of what I invest in are like regular stocks and usually UK listed. I won't necessarily categorize by market cap because to me, if you put an arbitrary line, below or above a certain value company, then I feel like you'd be missing out on a whole load of opportunities. So I tend to just categorize by the volatility. And then from there, I'll then research and look into or try to look under the bonnet and see whether something is actually worth investing in. And that's something I have been learning more about and trying to refine, just because I don't come from a background of accounting or any of these sort of areas. And obviously just coming, well, when I first started learning about it at school, I was learning and looking at balance sheets and cash flow statements and income statements for the first time. So that's something I'm always trying to kind of enhance, is my understanding of these different accounts and financial statements, so that I can better tailor the watch list that I have and invest in a more sort of prudent way.
So if we go back to the equity watch list, then what kind of things do you tend to look for, and what kind of sort of traits or qualities would a stock have to have then typically to make it off the watch list and into the actual portfolio?
A lot of my investing is top down, so I'll look at what's going on across the globe and then decide, right, well, now that I've worked this out, I don't know, for example, with the rising volatility around Trump's remarks on Greenland and other things that are similar, I might have a look at regions that would be affected or sectors that would be affected. One thing I have been more closely following recently is uranium, and that becoming more of a structural investment based on the energy requirements of AI and data centers. But generally speaking, if everything was kind of equal, low debt would be my first thing. If I can tick that box and a company has low debt, then I feel you're immediately worrying about one less thing that can go wrong. And the problem is that with interest rates where they are at the moment, uncertainty, just debt is just not something I want to have to be thinking about. And then the other sort of you'd think this is an obvious one, but the amount of people that buy companies that have no PE ratio, or a negative PE ratio rather, but a strong profit margin, because then those two things are always a decent sort of starting point. And I find it easier to invest in a company where I can see it going from strength to strength rather than being in a desperate situation financially and working its way out of that. But again, that's something that I am trying to evolve.
That leads quite nicely onto the next question then. So how have you evolved as an investor?
That's a really good question, because at the start I was buying and selling stocks because I like their name. If I was starting now with access to ChatGPT and all of the new sort of AI programs out there, I think that trajectory would have been far more linear in terms of me evolving over time. Just because you can ask it any question and it can come out with a decent, educated response.
That assumes you're asking it the right questions there.
That's very true, Sam. And sometimes you can ask it the right question and it still misfires. So it's not always right. But, when I started, there was no AI whatsoever. And so when I was asking people questions that I would now know the answer to, there weren't always people that had the answers. And so that made it really frustrating. So many of my stocks, when I was putting small amounts of money in, did poorly. In terms of my evolution, it's definitely been a complicated one. It's not been a straight line. I, as any sort of 14, 15-year-old would be, was incredibly impatient. So I'd be buying stocks for maybe the right reason. I'd have done a bit of research into their background, and they may have been in a sector that was interesting or promising. But then 5 days later, I decide, oh, actually, I don't really like this one anymore, and sell it. Whether I'm breaking even, I've made money or lost money. So I think in terms of evolving, well, one of the biggest things has definitely been patience. So pinning your hat on something and believing in the research that you've done. As long as you have a grounding of confidence in terms of the research you've done, then I try to leave it alone.
What are the best books you've read on investing?
One of the first books actually my dad bought for me was Investing for Dummies. So that is quite a basic, and it does what it says on the tin. It gives you a very, very simple but useful insight into the basics and the sort of technicalities of investing. I had that on Kindle, which was great because you can highlight words, you can add flashcards, you can look for definitions. And when I was starting, I had absolutely no idea what market cap meant. Other things like liquidity, I've always associated liquidity with water. You kind of take for granted once you've picked up the basics and some of the key phrases that you hear and use day to day. But for me, that was a strong starting point. I just needed something to look at and read and learn. But then after that, to be honest, it's been a whole plethora of things. I've genuinely listened to your podcast for a long time, Sam, and just plugging that in while I'm doing other things, going about my day, has often been quite a useful way to just pick up stuff by osmosis. You kind of passively listen to stuff and then you stop and you're like, oh, actually, that was quite interesting. And you just rewind and you listen to it again. And so I'd say almost more so than reading, it's been listening. I have played a couple of games as well, believe it or not. I don't know if you've ever come across Robert Kiyosaki, but he has a game called Cashflow 101, which I used to play with my family, that was amazing. A fantastic game for anyone out there looking to learn about not just investing, but also their own sort of financial management and becoming financially independent. And another big name being Tony Robbins, who I was listening to originally for things broader than finance, but actually he has some interesting outlooks into sort of managing your own money.
When did you start listening to the podcast, just out of interest?
After COVID, I reckon.
Okay, so
I don't know.
That'd be 21, 22.
And in all fairness, there have been periods where I haven't listened to it for a little
Yeah,
while.
I wouldn't expect someone to consistently listen for 4 years. I think.
Yeah, I mean, I don't put it in my weekly diary.
No, that's fine. That's fine. How did you find it then? Because you're not really on social media.
Because I was looking for an investing podcast. A lot of them were US based, and I listened to you guys, and you were talking about UK stocks. I was like, brilliant. And so I added you to my, can't even remember how it all works on Spotify, to be honest, but you sort of like save the account or something. And then from that point on, I've just always listened when I've had the time.
I mean, in fairness, that was why we started it. We both used to, I mean, less so now. I tend to do more audiobooks than podcasts. But when we started the podcast, I listened to a lot of podcasts because I do it when I was driving to work mainly. And like I say, most of them were sort of US focused. There used to be one very good one, and that was with two guys called Phil Oakley and John Newman. I think it was Investment Chronicle, but those two guys were really good. So Phil Oakley, is it Phil Oakley? Or is it Phil Oakley? I think Phil Oakley is the singer. No, Phil Oakey is the singer.
We're getting there.
Yeah. Phil Oakley is the stock picker. Phil Oakey is the singer, so you don't want to get them mixed up.
Well, singing and investing isn't mutually exclusive, so maybe they're the same person.
That's true, but they are definitely separate people. Theirs was quite good, but they ended up leaving the Investors Chronicle, and then after that, it was much more kind of macro stuff. It wasn't really individual stocks, and they actually set up their own for a time. But they had quite a lot of it was kind of focused more on trading at that point, and then
One thing I give you guys credit for is you're pretty consistent with the formula. You have different stocks that you tap in and out of over time. What I also like is you return to some of the same stocks as well. So you'll be
yeah,
talking about them at specific points in time that are relevant. And
yeah,
I find that quite interesting.
because we try and do it weekly. We tend to focus on FTSE 350 stocks just because we find them easier to understand and follow. Because a lot of the time you know the businesses, so for me it's quite important to be able to visualize what the business is doing. Whereas if you have like a US equivalent of something, but you've never heard of it, it's sometimes harder to actually sort of understand the business, I find. So FTSE 350 works really well for that. And then basically every week when we're picking the lineup, we look at stocks that have reported earnings.
Yeah.
And then what happens is if it's a quiet week for earnings, because what you find is a lot of them, they tend to report around the same time because they've got similar year ends. And then at that point, we might go and find something a bit sort of more unusual or go back a few weeks and do one we've missed.
It's funny you mention earnings. Did you see the Microsoft?
No, I don't follow Microsoft.
I mean, to be honest, nor do I really. But yeah, they reported earnings a couple of days ago and they beat both top and bottom line. But there were concerns over slowing cloud growth and investment related to AI, which I thought was quite interesting because that's something that I can see happening in the next kind of 12 months or so, which is a contraction starting with AI across the kind of the global market.
Well, we've done, so we just recorded this morning actually, but the one that's going out on Monday, what would it be, sort of 2nd of February. Experian and Walters Kluwer, both of them have taken a bit of a battering recently, and that's because they think they're going to be like damaged by AI. It's the same with like Rightmove and Baltic Classifieds, which we've covered more recently as well, which are both at kind of the best valuations they've been in years. And we were talking about it today, and sort of our conclusion was, coming from the perspective of someone who uses AI but doesn't necessarily know a huge amount about it, is I just think we're quite a long way away from some of these businesses being properly disrupted. So I think with some of them, it's actually, you've got almost like a bit of quite a number of stocks now where actually the valuations are the best they've ever been. And it's because they're almost priced as if AI is going to destroy the businesses, which I don't think we're really anywhere near for a lot of it. Because like I was saying, I'm going through the process of buying a house, and if I compare the number of minutes I've spent on Rightmove compared to Perplexity asking questions about the process, and even then, it's not replacing anything that Rightmove's doing. So yeah,
I agree. It's a weird one, but it's also a bit of a buzzword that just gets thrown
yes,
around. And I think the trouble is not necessarily. I mean, in Rightmove's case, for example, I don't think it's so much that there's a concern that AI will disrupt them so much as it is the money that they're just throwing at it without really defining what they're doing.
I know that's not ideal. If the money's been wasted as a shareholder, I'd be very, very annoyed. But at the same time, it generates so much cash that in terms of the long-term valuation, is that business worth 25% less as a
I agree.
consequence? I
No,
don't know if it is, although it's not ideal, and I'd be very annoyed if the money's been wasted. It's not something that fundamentally changes the value of the business.
I could not agree more, to be honest. But I think what it does send is a little bit of a warning signal about AI in general.
But it's like, for example, we did Games Workshop today, and they've got in their 6-month results, they've got a few paragraphs talking about AI, and basically they've put that in and said we don't really think it affects us that much.
Yeah,
But the fact they've had to put it in, I think, kind of sort of suggests how the market is in terms of everyone needs to know what's your position on AI. It's like, well, we make miniature figurines. We're probably not that affected. But they kind of said, well, we've got no plans at the minute to incorporate them into the design process or anything like that. Although we've
yeah,
got managers that are keeping an eye on what it can do, but basically we don't think it affects us. But the fact they've had to sort of put something in commentating on it, I think says a lot about the state of the market.
yeah. And they also don't tend to comment on something that's not relevant to them.
No, but I suspect they probably had people asking, and that's
Yeah,
kind of what's led to it.
it doesn't surprise me at all that firstly they come out with a comment that's relatively concise like that as well. But also that's one of the things I just like about Games Workshop is they're very transparent. They stick true to what they do best, and they don't try to overcomplicate anything.
What are your thoughts then on current valuations in the US versus sort of the UK and Europe more generally?
I think, to be honest, valuations across both the US and the UK at the moment are punchy. And as we speak, as we say about AI, just throwing complexity into kind of people's judgments on value and where value should be prescribed. I think there are considerable headwinds across both the US and Europe. When you look at the currencies, sterling is exceptionally strong, which materially affects relative valuations for UK based investors. So this in terms of the currency alone, makes US stocks look attractive. But I do hold the view that equities are due some kind of compression, value compression this year, with the first signs likely to emerge in AI and via AI exposed names, which is one of the reasons why I brought Microsoft up, Sam, where sentiment and valuations just are stretching, and there is not necessarily cause or real value add behind the use of AI, but just putting money into it and telling investors that as though that's fine, that's enough. We're putting money into AI. Don't ask us any more questions. And then the flip side to that is the amount of borrowing that's going on in the direct AI space. When you look at OpenAI, Google, the power requirements, the funding and investment requirements for the actual real estate to kind of house the power and the data center storage. As I say, like you take Microsoft, for example, who reported earnings this week, beating both top and bottom line, but fell 10, 11% over slowing growth. And that was relating to their investment in AI. Another thing that I follow quite closely is the index PE level. So in the US, for example, it's trading well above its long-term earnings multiple, which obviously adds an expectation of high growth, which I can also imagine coming up quite short. And in the UK, you have the FTSE's record performance over the last 12 months, which was driven in part by its heavy weighting in mining and commodities, which are two sectors that have done very well in this current sort of climate. But I think both of these indexes across the UK and the US, and what I mean by that is the kind of the big FTSE 100 blue chip names and their counterparts over in the US with the S&P 500 are trading quite high. I think the valuations are quite high. Well, the other thing is that the index is strong year. So the FTSE 100 climbing almost a record amount it slightly misrepresents the economy, especially working in the property sector where you have the likes of central London and outer London prices falling. That's just weak demand. You've got the Labour government enacting policies that aren't necessarily conducive to the movement of capital. So when you look at the construction sector, it can quite considerably outline how the economy is looking. And if people aren't building, then there is a lack of confidence in the market. There is just not the incentive to move to the UK, for example, as a business. In fact, a lot of companies are leaving the UK.
I think US, I can see where you're coming from, but I've been saying that about the US for 10 years, and whilst the valuations have remained high, they're not that much higher. And in fairness, the earnings growth over the 10 years have been absolutely phenomenal for some of these companies. Also in the US, it's really weird because you've kind of got the sort of top 10 companies basically propping up the entire market.
Yeah.
I think in the UK, though, I agree that the performance of the FTSE last year doesn't reflect how the economy's done overall. However, I think if you compare the FTSE and the S&P and you look at it over kind of a 20, 25 year period, the FTSE, whilst last year was a really, really good year, the FTSE's done rubbish.
Yeah, it's done rubbish.
I think on a relative basis, it's still a lot cheaper. And that's partly it reflects the type of stocks that are in the FTSE compared to the S&P because we don't have those massive tech companies dragging it up. Like as a random example, if you go from 2000, so if we go from the new millennium, so the S&P was at about 1,465. It hit 7,000 yesterday. So that's 4.77 times larger. So it's nearly a 5x. If you do the same for the FTSE,
hasn't any X'd probably.
No, it hasn't. No,
it'd be about the same price it was 20 years ago.
It's not far off. So it's at 10,223 today, and it was at 6,165 in 2000. So it's up about 65%, which is rubbish. Absolutely rubbish. But I think one good year for the FTSE, it doesn't change the fact that performance has been so poor. It could have another 4 or 5, 6, 7, 8, 20% years and still be way behind the S&P. And I do think when you go sort of company for company basis and compare the FTSE to the S&P, I think there's more value in the FTSE. So even after the year it's had, I think because it's on the back of so many years of underperformance. Because I mean, if you take out last year, it's basically been flat since like 2007.
Yeah.
It's absolutely ridiculous. I think with the FTSE, I'd probably disagree. But I on the S&P, I do see where you're coming from.
You disagree in terms of my view on the valuation of the FTSE at the moment?
Yeah, I don't think the FTSE is overvalued.
What I mean with the UK is that it's just not in an investable state at the moment. It's not necessarily overvalued, but I just don't think there's much growth or positivity that I can see if over the next kind of 2 years. That's really what I meant from an investing standpoint.
I kind of get that, but even then, I still think if you look at it overall, that probably is the case. But there's a lot of FTSE businesses where actually a lot of the revenue is coming from overseas, which makes a massive difference because they're not dependent. Now that being said, there's also the right moves of this world where there's basically no overseas markets, and there are a lot of businesses in the FTSE that tick that box. But there's still some really good international ones. But even then, I just think, well, whilst I'm not hugely optimistic for economic growth in the next couple of years, I think if you've got a quality business, there's still opportunity there. So it's like if the economy does rubbish, I don't know if Rightmove's the best example, but Rightmove's probably going to raise prices 10% next year for the real estate agents. That's
Yeah,
probably going to happen like clockwork. And some of these really high quality businesses, they're still going to be able to keep doing what they're doing,
yeah,
even though the wider economy is quite sluggish.
yeah. I could agree with that.
I'm sort of cherry picking the data there because I think it's very easy because you could easily counter it and say, well, I could pick out 10 really high quality S&P companies that you'd be quite happy to hold for the next couple of years. I think if you were holding a FTSE 100 tracker, I can kind of see why you'd be a bit more nervous. But even then, although the earnings growth might not be there, you could still argue that the valuation multiple's not huge.
I feel in terms of the valuation multiple, I think relative to the US markets, it's lower. But when you look at the makeup of the FTSE 100, I
It's
think
lower
it's more
quality companies.
or lower quality companies, and it has a more defensive,
Yes, I'd agree with that.
it's sort of yeah, a more defensive makeup.
What do you think about allocation and position sizing then?
So when it comes to allocation, for me, if I am confident about an investment, I'll just put any amount of money that I have available into it. And that's probably somewhere where I still need to develop my overall strategy. In the past, I've left myself overexposed. When I was first started, I got into CFD trading, where I was just putting down small margin relative to the overall position size, and I got bit pretty hard. But I don't like the idea of putting sort of an artificial cap on how much of a company I want to buy if I like it. And so far, since I've kind of decided, right, this is where my strategy is properly starting, when I first bought Games Workshop, I had, I think, £3,000, which I put into my lifetime ISA. And that's how I got into the lifetime ISA. And I'm pleased that I kept it and I was confident about it. I like the company. It's easy to follow just one company or a couple. I'm not so much of the view that you have to be diversified just by law. I 100% understand people that do. I think it's sensible to diversify, especially if you're not actively managing a portfolio. You need to reduce your risk somehow. And also having exposure to to more markets is really only a good thing. But for me personally, if I'm really confident about one or two companies, then I will just put all my money in them. And that could leave myself in a position where sudden underperformance or a change in sort of macro environment or sort of the economic climate could make it difficult. I look back at so Warren Buffett, for example, in the past has talked about liking one or two companies and his diversification being the research he does on the companies. Now, I do agree with that sentiment that if you are confident and you've done your research, then why put your money into a million different things that you're invariably not going to be able to track so closely?
I think that's a really interesting answer. I firstly agree. I think you need to be more concentrated to kind of have any meaningful chance of outperformance of the market. And if you're not going to outperform the market, you may as well just buy an index fund. If you buy 25 different stocks, there's some people, I mean, you look at Peter Lynch, he had loads and loads of stocks. So you can have loads of stocks and do really well, but most people who outperform, they tend to do it with concentration.
Yeah.
That being said, I'd be very, very uncomfortable being in one or two positions because you could be totally right on everything and the market could still move against you. You could be all in on a company and based on the research you've done, you might have done everything right. And then it turns out there's a fraud no one's picked up on. These things do happen. I think when you're younger, it's less of an issue because I think like sort of, and obviously I don't know the size of your positions and the size of your portfolio, but I think given your age at 22, I think if I look at my portfolio at 22, I think it was more concentrated. That's partly was driven by the amount of capital I had to work with because you get to a
Yeah,
point where the amounts get bigger
yeah,
and it's like, well, actually, I'm going to make up some numbers here. If your portfolio is worth £2,000 and you put it all in one position, you can be pretty comfortable losing 2 grand, especially if you've got a job that's relatively secure.
Yes,
If all of a sudden you've got a 200 grand portfolio, you're probably not going to be comfortable losing 200 grand because you know how long it takes to build it back up.
I
And
agree, Sam. I
I think
agree.
when you're younger, I think actually if you've got a portfolio, if we use the 2 grand example, if you have 20 positions of £200 each, which would be a well diversified portfolio,
Yeah,
that firstly some are going to do well, some are going to do badly. What's going to happen is there's going to be a couple of big winners in there probably. Those big winners on £200 initial capital are never going to perform well enough to make any meaningful difference to your life. I think what you'd be better off doing is probably just having it probably all in one or two positions, and then you're saving up, and then what you're doing is you're adding the positions one at a time,
yeah,
and that's rather than trying to have a diverse. Do you know what I mean? Because the whole point of diversifying is to reduce risk. If you earn 40 grand a year and you've got a 2 grand portfolio and it's all in one stock, what's the risk?
I completely agree, Sam. And the other thing is, if you open an account and you immediately buy, say, to use your example, 20 companies, I feel like you'd be spending as much time thinking about the allocation that you've given to your portfolio and that becoming essentially part of your investing strategy than if you buy one or two companies and then worry later down the line, if you're lucky enough that your capital has appreciated, to then start thinking about the correlation between one investment and another. And for me, I'd much rather spend all of my time ensuring that what I'm buying is the best thing I could possibly be putting my money in than the amount of different companies I'm buying to reduce my risk.
Yeah, I'd largely agree. Actually, I think if someone's listening in the 50, I definitely wouldn't do that. But I do think at your age, I
I
think
forget that there may be listeners. Yeah,
yeah. So I think at your age, I think building out the portfolio one position at a time, I think is pretty sensible because otherwise the investments are not going to be of size where they make any meaningful difference to you, which
agreed.
I think is ultimately kind of what it's about. So I think if you've got like a 2 grand portfolio, I wouldn't have it in more than two stocks because what is the point? You're just wasting
I
your time.
and this is something that will probably age terribly, but I do feel that as I learn more and more about the companies that I buy, especially once you're holding them, I don't know, for me, once my money's in a company, I can just carry on reading and learning. And, 3, 4 years down the line, if I'm still completely confident that that company is the right one to be in, then there is a certain element of me thinking, well, if it declines in value for whatever reason, then I'll exit. But if I'm truly confident about one company, where I just couldn't be if you multiplied that by 10 or 20, as in you're having to follow the financial statements and quarterly updates of 20 companies, then I'd be far more willing to hold on to a company that may have a downturn in the short term because I know much more about it than, say, a company that I've looked at once or twice and it's in my portfolio simply so that it's adding some negative correlation with the rest of my portfolio.
I think that's fine for where you are. I think if you fast forward 5 or 6 years, though, continuing that trait of having everything in one portfolio, in one company as the portfolio gets bigger, I think is a recipe for disaster. So at some
Yeah,
point, through no fault of your own, something will go against you that you couldn't possibly have taken into account at the time because it might not even be based on publicly available information. Your company could get hit by a meteor at HQ, and that there's nothing you can factor in for that. And I think again it comes down to, well, at some point it's going to get to a point where the position size is such that it's like, well, actually, would I be comfortable losing that money?
I agree.
And eventually the answer will become no, and I think the problem will probably solve itself.
I always think, well, you want to start as soon as possible. There's no better time to start investing than now because you find one company and then a couple of years down the line, you've got three companies. And as you get older, that diversification comes naturally because you've picked one or two stocks at a time that you truly believe in rather than just picking 20 from the
Yeah,
outset.
I'd agree with that. I think actually when you're younger, actually sort of picking 20 companies is actually really difficult because you've not been following them for long enough to actually understand 20. But yeah, you're better just sort of building it out over time rather than trying to go in diversified from the beginning. For our final question before we move on to your actual portfolio, what are your thoughts on Bitcoin as an investment?
I personally stay away from Bitcoin. I only buy things that I have an interest in for obvious reasons so that I'm willing to read about it and continue to monitor it. But with Bitcoin, I honestly think its use goes over my head. I don't know enough about cryptocurrency. I can understand its purpose as a decentralized entity. I can understand its use in protecting privacy of transactions, ensuring anonymity. But even that has its caveats when you look about or you hear about Bitcoin financing terrorism or trafficking or whatever. And the thing is, for me, where equities can be analyzed through their balance sheets, cash flow, and income statements, and equally where the bulk of commodities have clear structural drivers behind their valuation, I think Bitcoin sits in a category for me that I just can't properly define. And I genuinely don't know whether to treat it as a commodity or a currency or something entirely different. And I think kind of trying to be introspective, I think my inability to label it and create a reasonable valuation framework that works just puts me off investing in it altogether, especially when my strategy is sort of hyper concentration. It just doesn't work for me because I can't work out what its drivers are over the next 5 to 10 years. So I just stay clear.
So we're now going to move on to your actual portfolio, which will include your watch list and some sales, because otherwise it would be a very short section, this one. So we did talk about Games Workshop earlier. You said what a great company it was. You've recently sold it. So why is that?
So Games Workshop for me, it was the first real stock I bought for the right reasons. It has excellent management, its vertically integrated business model and strong alignment between employees and shareholders stood out. As you probably know, Sam, because I know you guys follow it on the podcast, I didn't personally know anything about Warhammer prior to investing in it. I first came across Games Workshop on your podcast, and I was like, well, there's a Warhammer store in Oxford. So I went and visited it. I bought a couple of boxes of miniatures and painted them literally listening to your podcast. And it wasn't personally for me. I enjoyed it for the time that I did it, but I can absolutely buy into why there is a customer base for it and such a loyal one at that. And yeah, for me, it's the quality of the business. They are transparent. They don't beat around the bush. Their quarterly updates are short and concise, but helpful. And I think they're a business that will just continue to do well. They were obviously recently promoted to the FTSE 100, and I think they'll be there to stay for a very long time. I think they're a great business. And I just sold it because, as we touched on earlier, just in terms of where I think the market is at the moment, and because I actively manage my portfolio and it's so concentrated, just to protect myself from downside risk, I sold because of the timing of the broader market more so than the company itself.
I would politely suggest you may have sold that for the wrong reasons, but I am very, very biased. I just think it's a business that everything you're saying about it is positive. It's very, very hard to find a business like that. You might think that the next couple of years might not be great for UK economic growth, but if you look at Games Workshop in 5, 10 years' time, I struggle to see a scenario where it's not bigger and
I, I
potentially a lot bigger.
I agree, Sam. I agree. The time horizon for which I'm not owning it isn't permanent. I'd be very happy to revisit it as an investment. It's still very much in my watch list. Just for me, over the next 6 to 12 months, I'm going to wait. It's a great company and it deserves to keep growing. But I could absolutely imagine buying back into it at some point. It's not gone forever.
I hope you get your timing right, but I definitely do not have the skill set to be able to do that. So I will just be sticking with it. So your only holding that you do have at the minute is gold. So could you talk about, well, I suppose you've touched on it, but could you just summarize why that is and
Yeah,
how long you
because
see yourself holding that for?
yeah, absolutely. I think gold for me is a relatively short hold period. I mean, look, like any investor, I'm trying to maximize returns. And so someone could look at my sale of Games Workshop and be like, well, it's impossible to time the market. Why would you bother? But again, I feel like I owe it to myself. From the reading that I've done, it seems to me like there's something coming. And the other reason why I started investing in the first place and from the outset was that I use it as a learning tool. And I didn't know much about commodities initially, and I'm still only scratching the surface, to be honest. I'm not someone to try and say that I know more than I do. But gold is particularly interesting to me because unlike many commodities, it has limited practical use. It's not the most conductive metal, it's not the strongest or the best for construction, and yet it's considered one of the most valuable resources on the planet, or metals on the planet rather. And I chose to buy gold because of the current macroeconomic environment. And so well, it's doing me well. And frankly, I'm just going to hold it until, to me, it seems like there is valid cause behind purchasing something in the UK. So whether that would be re-entering Games Workshop or maybe buying Rightmove because of this recent decline.
So that brings us on quite nicely to the next question then. So your watch list includes Rightmove. How long has that been on the watch list? And what would it take for you to actually purchase it? Because it's already fallen quite a lot.
Yeah, Rightmove, it's been on the watch list probably. It's one of the oldest stocks that I've been, well, the stocks that I've been following for the longest period, just because it has such a high profile household association. And naturally, growing up being interested in real estate, it's a company that's a bit of a no-brainer to add to the watch list, whether it was something that you'd ever buy or not. Just to kind of help also my learning process around the residential real estate sector. Its quarterly reports have a lot of insight into home buyers, the rental market, commentary as well about the overseas market, but not so much just because of the fact that Rightmove is pretty much entirely UK based. And then kind of looking at it from a financial health standpoint, it's just so cash generative. It does, its margins are so great. It's a strong kind of footsie business with one of the highest profit margins I've really ever seen, that well, at least that's sustainable. It has a moat around it where the entrance into its sector is difficult. And I think it's getting to a kind of valuation at the moment where I will be entering it at some point. You just have to. I mean, a business that's so strong and so consistent, having a blip because it's throwing a bit of money at AI, I think doesn't constitute a 30% fall. So again, I think as soon as I feel like my position in gold has yielded what I wanted it to, I think I'll be moving on to something like Rightmove. And actually maybe splitting Rightmove, Games Workshop, two very strong businesses that will, I just think, continue to do well. And Rightmove has that pricing power because they have the dominance in the market that I just don't think is going to go anywhere. I don't think you're going to have businesses coming across from other countries. I don't think you're going to have entrants into the market in the UK that are going to really compete with Rightmove. I've worked sporadically on weekends and a little bit over my gap year at estate agencies, and I know how much they rely on Rightmove's system. So yeah, I think it's getting to a point now where Rightmove is something I'd be looking to buy.
You've got Breeden on your watch list. Could you tell us what this is and why you like it?
Yeah, so Breeden provides efficient exposure to the UK kind of construction cycle with end markets such as infrastructure and house building benefiting from what should be long-term structural demand. Construction output is expected to accelerate materially from 2026 onwards. So the forecast is saying 10% in 2026, 11% hopefully in 2027, which creates a supportive demand backdrop for material suppliers like Breeden. And again, just because I have grown up investing and learning at the same time, it's a good business for me to buy into it now, or at least be following it, tracking it on my watch list, so that I'm learning about the construction sector, which helps with my own personal life and my job, but also waiting for a bit more, some kind of promising sign that the UK economy from a housing standpoint is picking up. And the other thing is there are expectations of monetary easing going into 2026. So the base rate is projected to trend downward towards sort of 3.25%, which would continue to support the financing conditions and construction activity that Breeden needs to do well.
I've never actually looked at it before, but it looks like it is on the FTSE 250, so I'll have to have a look at it on the show at some point, I think. You've also got Premier Foods. This is also a business I've not looked at before, so could you tell us what this does and why you
Yes,
like it?
Premier Foods is one of those great businesses. You should definitely have a look, Sam. It's not flashy. Premier Foods is a steady, durable compounder with a long track record of operational consistency. Their profit margins compound year over year, and it's never by staggering amounts, which keeps it relatively below the radar. It's not a high growth or high innovation name, but it's a dependable performer within the UK consumer staple sector. And the other thing is that it benefits from strong established brands such as Mr. Kipling and household names. They have something like a 95% household penetration rate across their different business lines. And that they demonstrate a disciplined kind of cost control model. They have decent margin resilience, and that should help their returns compound over time. It's a good buy for investors seeking stability, but I think it's one for long-term value creation rather than kind of thematic excitement.
I've just had a look at the brands actually, and yeah, there's some good ones there. So they've got, I mean, in fairness, I can imagine getting a 95% penetration rate with just OXO, because that probably is in, you'd think, every single
Yeah,
kitchen.
Bisto, Paxo, Home Pride,
So
Birds,
what?
Custard.
Why then is that on the watch list? and not maybe some of the other consumer goods companies in the UK? Because I think one thing we do have in the UK market, we might not have much of a tech sector, but we've got no shortage of consumer goods. So you've got Reckitt Benckiser, you've got Unilever, what's the other one? One that owns Imperial Leather.
Well, you also have Associated British Foods and
Yeah,
some of these
I
other companies.
mentioned them.
You also have Tate and Lyle.
Yeah, that's it. PZ Cousins, that's what I was thinking of. Basically, kind of no shortage of very high quality consumer goods companies. So why are Premier Foods on the watch list and not Unilever, for example, or any of the others?
Well, I think so. Okay, to take Unilever as an example that I think could represent the other brands as well, just to try and keep the answer concise. They have exposure. I mean, they're a conglomerate that cover so many different consumer goods. And for me, something like Premier Foods, it's on this. It's smaller than some of these other companies, but their kind of continued financial performance across all of their brands is so consistent. Their management is strong as well that I just think I don't think it's necessarily one against the others. I've just identified it as one very good stock across what is a sector that is decent in general.
You work in real estate, so have you ever taken a look at any REITs in the UK? Because again, I think there's quite a few REITs now where the valuations are looking quite nice, and for some really, really high quality businesses as well.
Agreed. REITs offer excellent access to diversified real estate submarkets for retail investors. And one thing about real estate in general is that it's not liquid like stocks are. So it's far more difficult to get exposure to real estate unless you have the capital. And so for that reason, I really like the concept of REITs. They come with their meaningful advantages, including favorable tax treatment, typically higher dividend yields for those looking for income, which make them, but despite the positives, I generally don't invest in REITs just personally, not really out of principle, but because whenever I've considered them, I've identified more compelling opportunities elsewhere. And as a result, REITs simply haven't aligned with my strategy at the moments when I've had money available, rather than being kind of excluded by design. But as you say, there are a lot of very good UK REITs out there, which for anyone looking for income, I think would be a very good starting point. But yeah, just at the moment, I'm not following any specifically.
So it's just opportunity cost, basically.
Exactly.
So yeah, so that's the end of my questions. You don't have anything else you want to add or any questions yourself, do you, before I wrap up?
I mean, the only thing I would add, Sam, is that if anyone's looking to sell any kind of real estate, or they know of someone, a family friend, that is looking to offload any kind of real estate asset, then feel free to get in touch, and I could have a conversation and pass you on to the right team if that's something that you're looking for.
So
That would
in
be it.
that case, could you tell us where people can get in touch with you?
Absolutely. So just email me. My work email is arthur.house@knightfrank.com.
And could you just summarise what do Knight Frank do for anyone who's not familiar with them?
Yeah, so Knight Frank are an agency, so we provide advice to all things real estate. We have a multitude of service lines that covers all kinds of real estate, whether that's commercial or industrial or residential, retail as well. We have exposure across the country and globally. And so essentially, if anyone listening has something that they'd like to do, whether they have the capital and they would like to purchase real estate for an investment or to live in, just get in touch.
Right, I think that's everything on my side then. So thank you very much for coming on the show, and thank you everyone for listening.
Thank you very much, Sam. Cheers.
Thank you for listening to The Investor Way. To get in touch, please follow us on Twitter at TIWTweets. This podcast is for entertainment purposes only and does not constitute financial advice. Neither Sam nor Jonathan are financial advisors. For investment advice, please consult professional advisors.